Okay. Hello, everyone. Can you guys hear me? I believe everyone's mic gets automatically muted. Oh, I see someone's Leon's hand going up here. Yes, please. Go ahead, Leon. Hmm. Yes, so I don't hear anyone. Can you guys hear me?
Yeah, we can hear you very well. Thanks.
Okay, good. I believe I just heard Costa, if I'm not mistaken. Okay, it's a good sign. Um, Let me just make sure that we're all set here. One second. Okay, so I see people saying that they can hear me. That's great. So I think we can get started. Let's not waste any more time here. We only have an hour, so let's that's good. Yeah, it came from Timu actually. So from China with love. Okay, so let's excuse me. I've been battling a little cold here. My kids, they're always getting sick at in kindergarten, so I'm constantly feeling a little sick myself too. So here we go. Okay, so we can go ahead and start here, I believe. If if someone has any questions, I don't think we need to be like super formal here and like raise our hands or anything. I think if someone has a question, we can probably just go ahead. You can just go ahead and unmute your mic and go ahead and ask the question, and we'll kind of just take it in that kind of format from here, where whoever has a question can just basically ask like we've done in the past, and then we can move on. So I see there are quite a few people here now, so I'm sure someone has to have a question. So
I could start it off. I have a question.
super.
Uh, what are your comments on like the China stocks? I mean, they've been really taken off lately, and it seems like the backdrop is good. Like the Chinese government's going to stimulate most likely, and just things have been sort of really low valued for a long time. Um, yeah, and then everyone knows kind of the American market is in a like the worst performing market this year. What do you think about switching some exposure to China?
Yeah, I've been looking at Chinese stocks a little bit more recently. And of course, I had them in my portfolio for a long time, and part of that time frame they weren't really delivering. So yeah, I recently got out of Baidu, but Baidu really wasn't performing as well as Alibaba and as JD.com and as some other stocks. So really, I do like China here. I have been thinking about um, building more exposure to China. I do have some exposure via ETFs. Um, but I don't really have much like individual stock exposure. Um, Now, the way I view China, it's not like a must-have. It's not something that, I need to own. And maybe that's partly because of like the really poor returns that Chinese equities were delivering for a long time. Um, but like on the other hand, I really do like the story as you said that they have the stimulus that's going to happen. Likely, growth could be better than expected in China, and China has really been in a downturn for a long time, so it's logical for things to improve. And I do like the idea of more Chinese stocks. Now, the ones that I would really um, kind of put my focus toward. Maybe Baidu, but there are some issues there with like Bing encroaching on their search revenue and kind of their AI program not being quite as advanced as it was hyped up to be. So I see some issues with Baidu in the near term. So I would rather go with Alibaba, with JD.com, because they're doing really great. And also maybe some Chinese stocks, or I'm sorry, some EV stock. Now, Li Auto recently declined because some some like not such great news came out. But I do kind of like the XPeng, um, the XPEV that I wrote about recently, and actually the stock had appreciated, quite well after that. And I still like the company here. So I think if we go with an EV stock from China, it may be the XPeng stock. That's kind of my view on China. In regards to the US market not performing, I think, we probably all maybe know why that's happening, and that's, because there's a lot of just the whole situation now with the best way I can explain it is maybe in one word, just misunderstandings. There seem to be a lot of misunderstandings regarding, where the economy may be going, where the future of the federal government may be going, and just there is a lot of uncertainty, and of course that's a short-term negative for stocks, but we also have to kind of, put things in perspective, and it's really, you know, the fears may be overblown here. There really could be, this kind of maybe a transitory phenomenon where this where kind of some of this uncertainty can gradually kind of move out of the market. And I guess, I'm probably going to get some questions about the Atlanta GDP, Atlanta Fed GDP, the revision, to down to 3.5% or whatever from an up 2.5%. So of course there are these concerns now, and they kind of just materialize really quickly. But, we still have to put everything into context, like the outsized gains that we had after the election towards the end of the year. So we were discussing that it was very likely that after the inauguration, we would see a bigger pullback. And perhaps, we are seeing it now. And this is kind of a logical time for it as well. So I guess the question at the end of the day is how how big will this pullback be? When could it end? And this is a bit of a complicated question because it's very difficult to time the exact bottom of these, of these pullbacks or corrections. I mean, the Nasdaq 100 already hit the 20,000 level. Is that going to be the bottom? Of course, that's not 100% guaranteed. We can definitely retest that level, and it looks like, the market's kind of gravitating towards that retest at 20,000. That would be very logical. Now, as far as breaking down below it, I think it's a less than a 50% probability event here. It could happen. Maybe it's about like a 40% probability. So we could get that breakdown at 20,000. How lower could it go? I really don't think that it's going to go much lower. Maybe 19 and a half, maybe 19,000. Now we're talking about a big correction. If it gets down that low, we're looking at, 13 to 15%, which is pretty massive when you're talking about a correction. And I know that there are probably some viewpoints out there that this is not a correction, that this is, the beginning of a bear market. But I would caution people to maybe step back and not to rush into this kind of, I guess, mentality and this viewpoint, because it's first of all, there's not enough information out there to kind of um you know aside from the Atlanta GDP figures and some other recent data points, there's really not that much data that suggests anything, about a recession being inevitable or even a high probability event. And so I'm just really skeptical about being too panicky here. I don't think this is the time that we should be, that we should be selling stocks. Instead, I think we should be looking at high quality stocks, increasing high quality stock positions and maybe looking to increase at even lower levels if they do materialize, but that's not, of course, guaranteed here. Sorry, I think I
Okay.
hope I answered your question.
Yeah, thanks a lot.
Okay, cool. So we can move on to the uh to the next question here. Whoever has one.
Victor, it's Leon.
Yes. Hey, Leon, how are you?
Um, Hi. Now, in one of your morning reviews, maybe 2 weeks ago, I recall you expressing some concern about a certain support level being broken on the index charts, and you suggested you might reduce some exposure if that support level was broken. And I was scrolling back through Rocket Chat just before trying to find it and didn't quite manage to. But I'm wondering if, so from what you were just saying now, it sounds like you might have changed your thinking, like you're not looking to reduce exposure based on weakness. Um, could you talk through how you're thinking about? I mean, is there any point at which you would reduce risk based just on the price action, or are you rather looking at how you see the economy and the market really developing to form a view on that?
Right. So it's of course a combination of all the factors, where it's the technicals and it's the fundamental factors, and it's basically all these elements combined. Now, regarding the level that that I discussed, potentially reducing some risk around, um, it was I believe it was the S&P 500, 6,000 to 5,950 support. So that was the level that I did mention it, and I did consider increasing some hedges, just some covered call dividends and maybe some collars or some puts on some options. I did consider this, and I did consider reducing some positions like Tesla at around 350 or 360. I thought about, reducing more after publishing the recent article. And of course, looking in retrospect, there were some things that could have been, handled differently. I that there's this one instant, I like to do this. I like to go back and look at some market, just some different market events and developments that occurred, and kind of, just going back and just going back over them and kind of looking at some things that we could have done better to achieve better results. And of course, looking back now, we should have taken some more profits. There was a key event on Friday before last, not last Friday, but the Friday before last Friday, when it was right at the end of last month, and it was the consumer sentiment data that came out, or it was close to the end of last month. And the consumer sentiment data was really quite a bit lower than expected, the Michigan consumer sentiment data. And that was really the point that I believe we should have taken some more near-term profits, and hedged more around there, because we had like a key reversal that day. So in retrospect, definitely around there and slightly lower, we should have been a little bit more proactive in harvesting some more profits, and instituting some more hedges, definitely. But again, now, um, there there are several reasons why I didn't do that. First, well, I did increase some cash, cash by about 5% or around the tops. I did, institute some hedges in several positions. But I did take them off a little bit earlier than they should have been. And I guess some of the reasoning for this was that really when I was looking at the technicals, yes, they looked weak and it did appear like the breakdown could occur. But then when I said to myself, like, how deep will this breakdown likely be? It just didn't seem like the market would probably go substantially below that support level. So it didn't really make much sense to just um, reduce many positions then because we were already looking at many stocks like Nvidia and you know like Tesla and other significant holdings that they were already down by so much. It didn't really make much sense to reduce more at that particular level, which is probably why I held off on taking more, on reducing more there. Now, in regards to reducing more down the line, again, it depends on the situation, but I don't think that aside from increasing some hedges and maybe just basically like decreasing some risk briefly if it breaks down below 20,000, the Nasdaq 100, I mean, I don't really see it going much lower than 19.5 or 19,000, and that's if 20,000 breaks down. So I mean, we have a lot of ifs in there. So it's possible to do to maybe increase some short-term hedges, like whether it be shorting futures options or whether it be implementing some inverse ETFs or whether it be, picking up some VIX products. Although I don't think that's very wise here because they're already kind of high, the VIX products, and typically when they crash very quickly. So we must be very careful with those. Um, so I mean, again, we can implement some short term hedging via these instruments. But I would caution people to go, to kind of just like liquidate their holdings or do anything rash here because again, we've seen over and over again that these dips they become buying opportunities. And yes, the sentiment seems pretty bad here, maybe even like terrible, horrid, use whatever word you like. But at the end of the day, sentiment can shift on a dime, and we could really see, this poor sentiment potentially improving quickly, whether it be on a technical reversal or whether it be on some positive, more positive news flow. Um, we also get these. I think we need to consider that we often get these news flow cycles where we saw like really what appeared to be positive news flow around the election time, where everyone seemed to be, or many people seemed to be very excited about a Trump presidency, how, the tax cuts, deregulation, fiscal stimulus, and other elements would really, really be positive for the economy. So we saw like this ultra optimism, and then kind of the positive sentiment faded, and then the news flow sharply started focusing much more on tariffs and much more on potential inflation, potential lower growth, and so on and so on. So we saw a really sharp shift to a negative news flow. And so I guess my point here is that we can see um, sentiments shift occur really quickly and unexpectedly. And all it could take is, maybe a technical level or some changes in just basically some positive news or a number of elements that could materialize and could really make that sentiment shift to a much more positive sentiment at any given moment. So that's why I'm so cautious to, reducing some core positions significantly or, taking other rash decisions without kind of more clarity or more visibility or more evidence on the table. I hope that answers your question, Leon.
Okay. Yes. Thanks, Victor.
Okay. Cool. Let's move on to someone else.
Victor, when you say long-term, short-term, intermediate, can you give us a rough estimate in months what you mean by these?
Yeah, absolutely. So, when I talk about the short time frame, that typically refers to weeks, maybe, maybe a month. So, sh short time frame could be, I think, it's probably we can classify it as like a 2 to a 4 week time frame. Intermediate term is more of like a 3 to a 6, in some cases 3 to like a 9 month time frame. And then when we're talking about longer term, we're talking about, 1 to 3 years or longer.
Got it. Thank you.
You're welcome.
Hi, Victor. It's Nikita speaking. I have a
Hey,
question which is not like directly related now to the whole, let's call it ambiguity in the market. I would like to know, like, what does your daily routine look like as an investor? I'm not. Don't start from the moment when you start brushing your teeth, but generally, like, how does the research process for you look like? Would be kind of insightful to see, to understand, what are all the angles and pieces you're trying to put together.
okay. That's an interesting question. So typically, um, my research process revolves around just studying the everyday moving fluid technicals in various markets, fundamental, developments in various markets, any type of, addressing any type of critical news events that could be, coming out in the near term. But I like to pay especially close attention to, of course, what the Fed is doing because that's very important for markets. And basically anything that's impacting sentiment in any given moment because, sentiment can be impacted by different elements, differently in different moments. So basically, I think it's important to pay attention to where, like where the where the news flow is occurring now and where it could be happening like in the near term. So right now, for instance, the market is very much focused on tariffs and kind of like the negative implications that they could have on the American economy and markets in general down the line. But for whatever reason, they're not focusing on the on the really positive developments like the $100 billion investments that are going to be made by Taiwan Semiconductor, by Apple, by Oracle, by SoftBank, and by many other companies that are going to invest much more in America, um, whether it be tariffs or due to tariffs or not. I don't think that that's really relevant. I think the relevant takeaway here is that America is becoming the place to invest once again, and that's really positive because it's going to impact manufacturing very favorably. It's going to impact the consumer very favorably because it's going to be many high quality jobs being created, much more, much higher quality jobs and much more productive jobs um, than many of which we have right now. Um, so I mean, there are positives upon positives really with with the, with kind of the current economic initiatives and the longer term impact that they could have and that they should have on the American economy. I think that the market is focusing now too short term on the negative elements and really not paying enough attention to the really beneficial intermediate and longer term elements. Sorry, Nikita, did you have like another element of the question that maybe I didn't address? If I didn't, I'm
Yeah,
sorry.
I was just wondering, like, for example, when you as an investor, when you wake up and then you have your watch list or you have your technicals. I mean, I'm just curious, like, how does your process of choosing stocks, for example, this MongoDB stock, which you put the article together. How did you come across this stock, for example, just as an example?
Yeah, okay. So it's an interesting question. Most of the stocks, like I would say like the 95% majority of the stocks that I deal with are actually stocks that I'm very well familiar with, and I've been, either I've invested with them, at some point in the last 25 years, or or I've done research on the company or something. But most of these companies that are in the all weather portfolio or that I write articles about, it's companies that I've known for many years, some for 5, some for 10, some for 20, and some for longer. Um, MongoDB, in particular, it actually got someone in the group suggested the company, or actually several people in the group kind of pointed it out to me. I did, I did some research on it. It looked decent, but we see some issues with the company now, with basically an earnings unexpected earnings slowdown. So. Um, and other companies, I also some people in the group may suggest them, or maybe I could read about it somewhere in Seeking Alpha or something like that. But aside from that, I don't, I just mainly deal with companies that I know for a very long time.
Thank you.
Okay, you're welcome. Okay, so we can, if you guys want, we can move to another question now.
Not to monopolize your time, but just a broad question about gold, silver. I mean,
Yes.
it's like it's on fire, and like the backdrop is going to be very supportive of it going higher. Like probably, like who even knows if it will end at 35? It could even go to like 4,000 or higher at the end of the year, depending on how things go this year. I mean, we've always had a big exposure to it, like I think at least 10-15% for the last couple of years. But do you see that going like to 20% or 25 or in any situation?
I mean, yeah, that's a good question. And I just wanna highlight that there have been instances in the past where I've had the GSM, the gold and silver position, at 20 or like 25% even. So I've had it up there. Um, yeah, I do think that we have a very bullish setup for gold and silver here, but it's not exclusive to gold and silver. I think we have a really, if you kind of look a little bit past um well, what I view as a transitory like volatility phase that we're kind of going through now. If we look kind of if we attempt to look past this phase a little bit, I think that we could see many sectors, doing really well. Um, Now, regarding gold and silver, yes, definitely. I think we can have more exposure here. Now, some of my top plays, again, Hecla Mining. Now, look at this from the perspective as it being, um, it's basically like, I mean, it's the biggest United American silver miner. So it's in that respect, it could be looked at as a more coveted kind of resource, especially in this age of tariffs and of some, of some of this uncertainty. And basically, I think it should be valued much more right now because there's really not that many companies in America that are big silver miners. So I think Hecla Mining can really shine in the future. And as far as gold miners go, I really like Barrick Gold. I mean, aside from their problem in Mali, if they can kind of, and I think they're handling it, if they can kind of move away from that region a little bit, I think that they can do really well. And also, I like Newmont Mining a lot because it's a huge gold miner. There's a lot of efficiency progress that can be reached, that can be achieved there. And I also like, of course, Anglo Eagle Mines, the massive Canadian miner. I think it's just the best mining, the best gold miner, management wise, and just probably the best gold mining company globally. So, I mean, those are my like three gold mining picks, and the Hecla Mining I think is a top silver mining pick. So, definitely, I think we can be increasing there. It's not a problem.
what would you see needing to happen to do that? Because or would you just do it anyways? Or would you look for some particular kind of trigger point to do that?
I mean, I don't think we need a trigger point, but if we see like a bigger pullback in gold after this volatility phase concludes or as it concludes, I imagine we could see a bit of a tick down, just a temporary tick down in gold. I think that could be, that could be like that could create a buying opportunity basically. But aside from that, I don't really see like a major, I don't think that we need a major trigger to buy more gold miners or silver miners here. I think it's more of like just just your own um, kind of kind of preferential allocation size in your portfolio, whether you're comfortable with with a 10% position, 15, 20, or maybe even a higher position in GSMs. I don't see any problem in having like a 25 or even a 30% position in GSMs here because it reduces some of your risk because it's really good diversification in regards to having like a big tech holding position because it plays as a counterweight to that. So usually if tech falls, GSMs can decline. It doesn't mean that they can't both appreciate at the same time. We see it plenty of times, but just oftentimes when we have a risk off environment in some stock, in some higher flying stock segments, the GSM segment can kind of play as a good counterweight in that situation. So I think it really comes down to a personal preference of how much GSMs we want to own at what given situation. And I mean, I like the segment here. We have a healthy allocation, but I don't see a problem in having more GSMs here too.
Okay.
Okay, cool. So I have a question here in the Zoom chat. So it says, "Hi Victor, given the recent pullback, it seems that reaching the 40% year-end return target would require recovering recent losses plus achieving original target, making it a greater challenge. Are you still maintaining a 40% return target? If so, are you expecting names like Tesla, AMD, and Dell, Sentinel One to lead and get us there, given their higher weightings in the all-weather portfolio? Thanks." And this question comes from Michael P. That is a great question. I like it. I like it a lot. So the simple answer is yes. I still, I'm keeping my, it's not 40%, it's actually 40 to 50%, um, you, to 2025 target range, 40 to 50%. And yes, I am keeping it. And the reason I'm keeping it, the reason I'm not lowering it is because when I was instituting this range, I basically I wanted to lowball it. So in case we did have an event like, like we're having now, a correction that I didn't anticipate in all fairness. We may not have, traded it 100% perfectly, and that's primarily because I'm not a trader and I don't like to trade in and out of positions too much. Regardless of that, I did I did anticipate a pullback and a correction in the beginning of the year. So I don't see a reason to lower the the full year return. If the correction really gets bad and if it looks like, it's damaging technicals to a point that they're probably not going to recover, then I will get more concerned and then I will lower the targets. But I don't see a reason to do that yet. Um, and I do see that many of the really badly beaten down stocks like Tesla and like AMD, like Dell, like SentinelOne and like many others, like Nvidia and many others in the tech space, like the nuclear stocks. Um, so yeah, again, I believe that this is just a transitory rotation out of these names. We need to see these healthy pullbacks, these healthy corrections. I know it can be painful to watch. It can be, it definitely can be painful to watch some of these big moves lower, but that's just basically how it always is in a correction. And I don't think that we should be lowering our targets here just because the market is going through a correction. Um, yeah. So I think I answered that question. Good.
Yes, thank you, Victor.
Okay, and we have another question here in the chat. It's from Ashok, and I know Ashok very well because we had a private mentorship session, and I think it went very well. Um, and so the question is, are you planning to add MRVL Marvel if it drops further? I was thinking about it at around 100 level, but did not add. And I remember that we did talk about Marvel at around 100, and I also remember that it looked better technically, but it didn't really, quite look like it was a good time to buy quite then. Now, however, I do think that now the market has brought it down to like, around $70, it looks really attractive. So, I mean, 65, $70 range, I think we pulled the trigger. Um, I would buy it, but I'm a little hesitant to go into the portfolio and do more adjustments here just because I've added to a lot of the names recently. We're already heavy in the semiconductor space. So, I guess it does make sense to build some exposure to Marvel, and if I had cash on hand, I would definitely do it. I think around here, I'm not seeing how the stock is trading at the moment. Let me look. But I saw it at around 73 in pre-market, and it actually hit around $71 now. So I mean, I think you pulled the trigger here. At least for an initial 50% position, I think you pull the trigger here. If you're long the stock, I think you DCA here for sure. Um, and if you're not long the stock here, I believe that at least about a 50% position here seems very reasonable. And then if it goes marginally lower, 65 or whatever, in like a worst case scenario, if we could see it down to 60, I just don't see it happening. I mean, it's possible because of course the market can go lower than you anticipate and all that. But I mean, looking at Marvel here longer term on a chart, we see that it did so well, and it was it was around the August panic low, it was around $55, and I'm not even sure that we can count this blip where it went like really low. So I mean, we should really be looking at like $60 as the as the low around August, if we kind of disregard the real irrational market price action. And it's already around $70. And we've seen really, really stellar results since then. And just, these recent earnings, they were not bad. It's just that the market had basically pushed the stock up way too much, way too high, and the valuation became kind of obscene here, around 120. So this drop was to be expected, but maybe not this much, Sure, around 100, around 90, even 80, but down to 70, it just seems like it's getting way, way overdone here. So I'm definitely a buyer of this stock, of this stock here. I certainly like it at this level. And again, looking at just some of these oversized kind of moves after these earnings, it also gives you a perspective on just how much fear is in the market now. Like I'm looking at MDB here, and it's down already by 23%. So we're approaching that $200 level. Now, this stock has its own stock specific issue, company specific issues, of course. But again, I mean, some of these drops are just extraordinary, and I think around $200, MDB is probably, it's probably a good level to put, it may be a good level to pull the trigger on an initial position at least. But I do think that this stock could potentially move a little bit lower, just because the guidance was really not great. But Marvel, it's a different story. The guidance here was really solid, and so I mean, the stock is just getting basically massacred here, and it's I can't I can't say that it's fully justified. I mean, maybe a $10 decline, or like a 10% decline here, but um with a bounce back. But Marvel, is down by 20% here now. So it looks like panic selling here. Okay, good.
Victor, it's
Yes.
Jeffrey this morning. I'm sorry I was a few minutes late, so I might have missed this. But with regards to the federal jobs that Doge is going after, is there some kind of uptick in unemployment that you're looking for at some point? And how would you judge that?
Yeah, definitely. So that's certainly one of the more negative short-term elements that we're observing here. And I'm definitely more concerned about this than a lot of other things, because um there seem to be a lot of jobs on the chopping block, and it seems like at least some of the jobs are probably, it's justifiable to possibly reduce some of those jobs, just because of um some of the news that we've seen, about basically, many of these jobs not being very, very productive, like at all. So, of course, there are going to be reductions in jobs, and, at the federal level, and it's concerning, and it's something that we need to watch out for in the upcoming jobs data, and probably even more so in future jobs reports. Now, exactly how that's gonna reflect in the numbers. It's challenging to predict. Probably it can't be too great, but I have a feeling that the government is going to do something in the data to kind of maybe, to tweak the data to account for these jobs. So it may not be as hurtful, to the GDP and to other elements and to other data points as the market seems to think here. Again, it's not guaranteed. There's a bit of uncertainty here. Um, but yeah, we should definitely be mindful of the jobs data. And on a positive note, I think that some of these jobs that we could see an offset of some of these government jobs being, you know, being cut. I think that this could be offset by more jobs, more quality jobs being created in the private sector, more manufacturing jobs being created. And yeah, so basically we can look for some data to offset the negative, the negative jobs data from the government, I guess.
Thank you, Victor.
You're welcome. Okay, so let's get to another question here. Um, I see a follow-up question from Ashok. It says, thank you, Victor. And the same thing happens with CRDO. Great results, but it's one of those stocks. Yeah, so I mean, CRDO, I've heard about this stock. I've been looking at it recently, and again, it's getting annihilated here. And this again, this goes into the theme of all these, I guess, these high flying, really, really high multiple stocks that certainly got ahead of themselves, like, whether it be AppLovin, whether it be Palantir, whether it be Axon, or I mean, there's just the list goes on the nuclear stocks, Tesla. Yes, of course, these stocks, they got ahead of themselves. The momentum trade, it it um it came up, it went up too high, too quickly. There's no debating this fact, and now we're seeing basically an unwinding of this trade. Now, is this something that could last for, for some more time? Because I mean, it really hasn't been this long with these pullbacks. Like, I'm just looking at, for instance, CRDO. Yeah, so it's been declining for close to a month now, so it's pretty good. It's down more than 50%. So, I mean, here around the 35-40 level, I think you pull the trigger on the stock, like, really, because um there's the earnings were good. There's a lot of growth ahead. It's just that a lot of momentum it's being unwound here. Now, um, there always comes a time where, where the unwind ends and then the buying begins. Now, is it going to happen here at $40 or is it going to happen at $35? Could it happen at $30? You're never going to get anything 100% um, right timing wise in the market unless you're really, really lucky. So, again, I look at the chart and I see many, many buy signals here. I mean, I see indiscriminate panic selling here. So it's basically investors saying, that's it. I'm scared. I'm panicking. I'm selling. I don't care about the prospects of this company or any other company at this given moment because my emotions have taken over my reasoning process. So that's it. There is no more reason to own the stock. It's just all emotions, and my emotions are saying sell, sell, sell. So I'm gonna sell. That's what I see happening here with Credo Technologies and with with all of these, basically with most of these momentum stocks. Let's see what Palantir is doing here. So Palantir, again, we had a bullish reversal in recent sessions right around 78, $80 support. This is a key support level. Then um, 2 sessions later, this support level got retested successfully. Now Palantir, again, it's having a bad day, but it's not anywhere near around this 78, $80 low. It's now around $85, and it's actually rebounding off. We could argue here that Palantir possibly bottomed at $78. Now, again, the valuation is still elevated here, so I'm not screaming, jump in and buy Palantir, but definitely we should pay attention to the price action here because it's looking much more positive in stocks like Palantir. And this may be a sign that we can buy stocks like Credo Technologies and like Marvell here and others. So again, Marvell just touched down on around $71, which is right in that kind of right around that $70, $65 support level. And it appears to be having a bullish reversal here now. So again, I encourage people to look at the positive elements, not only the potential positive um, uh, fundamental factors, but also at the positive technicals that are occurring in some of these momentum stocks, in the mag stocks, in basically in the nuclear stocks too here, because we're seeing again, if we look at a company like Vistra Corp, now this is not like Oklo or like SMR where there's unproven profits. This is a proven profitable company with likely a lot of growth ahead. Now, we saw it drop down to around $115 recently. Now it's retesting that level today. If we see continued strength and we see a close above 120, that's very bullish. And I think that we're seeing a lot of bullish, what appear to be bottoming patterns in many of these stocks that I'm looking at here, these momentum stocks. We've seen like 40, 50% corrections here. And these are corrections here because we've seen like 100, 200, 300, 400% moves in some of these stocks just in the last year alone. So when you're seeing a 40 or 50% downturn, that's just a correction in this market. I hope that answers your question. And let's maybe get to one or two more questions here because we only have several minutes left here, unfortunately. So, okay, I have a question from Eva. It says, any thoughts on Lee? Do you see, or Lee Auto, this is, do you see any short-term benefit from Tesla sentiment? So, Lee Auto, it's an interesting company. Let me pull up the stock here. So Li Auto is an interesting company. I put out an article about it relatively recently when the stock was around a low point. It was at like $23, I believe, when I wrote the article, or around $22. Then Li Auto, we knew about the positive news that would come out. Li Auto surged to $35. So I mean, it had like a 50% move after I wrote that bullish article on the stock. But the stock got got too hot. It got ahead of itself. We had a reversal. Now we're seeing a sell off. I think it's a buy again around this 25, $27 support range. I think it's a good area to get back into Li Auto. Now, it's not so much that Li Auto is probably going to benefit, although it could benefit a little bit from Tesla's downturn in China because of the Model 3 refresh, because many people in China are waiting for the new Model Y to, and not only in China, all over the world, waiting for the new Model Y to come out. I mean, why buy the old version when the new model is going to come out? It's kind of like the iPhone. Why buy the iPhone 16? Like, I'm not going to buy the iPhone 16 now. I'm going to wait for the iPhone 17 because it's the new model. It's going to look better. It's going to be better. So it's similar with the Model Y here. I mean, why buy the old Model Y when you can buy the refreshed and the new Model Y soon? Now, Li Auto specializes in these family-oriented Model Y, Model X type vehicles, and they even have a like an MPV variant. So I like the company, and I definitely like the outlook, and I like I like this company, and I like XPeng as the alternative EVs to Tesla in China. BYD, I think it still has a good story, but it's been kind of played out a little bit. NIO, I think, is a little bit too risky for my preference. But Li Auto and XPeng, I think they're in that right kind of risk reward ratio um, area where I think we could own these stocks. So yeah, I think I like Li Auto here around 25, 27 $27. I think it could do well here. Okay, so yeah, that answers. I hope that answers your question, Eva. So I think we have time for maybe one or two more questions here. So does anyone in the Zoom session have a question, or I could go to some of these in chat here. So next question, what could be the catalyst for the next market leg up with these AI momentum growth stocks? So I think there could be various catalysts. A potential catalyst could be just good earnings from Broadcom that are coming out very soon. So we see Broadcom trading down to $177 here today, which I think is, and it's actually having a bullish reversal here now. So I would definitely be a buyer of this stock here, and I would actually like to add this stock to the all-weather portfolio. And I may make an exception here and actually sell something soon just to add this particular stock and maybe even some Marvel shares here too, because I think that these companies have enormous potential in the customized accelerator market, which is basically a um, a competing market to NVIDIA GPUs. So I really like this segment here, and I think Broadcom is going to report a really strong quarter, and that may be a catalyst to take these AI stocks higher. Other catalysts could be just basically um, more announcements of AI infrastructure spending from the government, um, from top tech companies, any kind of news flow, positive news flow, in improving news flow about AI spending, and I mean the thing is that we really haven't heard anything negative in regards to AI build out spending. It's just basically the market assuming and panicking here. So I really I really see a bit of a problem with that, and really I just see it leading to buying opportunities here in the near term. So I think that the market is being overly negative and overly pessimistic here without really having the proper um, the proper evidence or the proper um, you know the proper triggers to make it so negative and so bearish about the AI stocks and about momentum here. Again, I think it's primarily a constructive um, reset in technical conditions and a positive reset valuation wise, because again, trees they never grow to the sky, and we can't and we should never expect stocks, and especially momentum stocks, to just go up indefinitely. It's not realistic. It always leads to substantial pullbacks, and we're seeing these 50, 40, 30% sell-offs here for a reason, and it's because many stocks just became obscenely overbought, and now we're having an unpleasant rebalancing phase. Okay, guys, that's all the time that we have today for our Zoom session. I hope that I answered most of your questions, and I think that we should do a follow-up Zoom session in about a month, and we could maybe make it an hour and a half because this hour just blew by too quickly. So yeah, we're gonna do another Zoom session soon, and we're gonna make it longer. And I think it's gonna be at a time when the market is doing much better than it is now. And by the way, we're seeing a continued reversal here in Broadcom and other stocks. So I may actually make some moves here in the portfolio. So thank you, everyone. I appreciate you being here. Thank you for your questions, and I will speak to you all very soon. Thank you, and
Thanks, Victor.
Victor, have
thank
a
you.
good one.
Thank you, Victor.
Bye bye.